Let's welcome on board Sri Krishnan H, the MD and CEO at Kanataka Bank, joining in right now to talk about how their numbers have been. Mr. Sri Krishnan, great to have you on the show. Just going by a quarterly performance in terms of advances as well, if one picks up the commentary from your last quarter, you anticipated a 15% growth for Q3 and 4 and 18% growth thereon. This quarter, you've grown around 12%. Do you think the growth engines will ignite? And, is it a conscious call from the bank to focus more on margins as opposed to and quality?
Good morning. Thanks for the opportunity. Yes, you're right in a way that, we are focusing on quality over quantity, that's for sure. And that's a conscious strategy that we've been adopting from Q2 onwards. Having said that, there is also a market slowdown because of the overall GDP growth, the credit offtake, and so on. So as a result of that, from the 9-month period, that we have seen, we have grown the assets to a reasonable level of about almost, closer to 11.5%. So which is fine, I think. And given the current outlook based on the budget and thereafter, I think, this is going to be a good kind of a quarter in Q4. And I think, the year will close on a high note as far as the overall advances book is concerned for us. And the good part is that the quality of the book, which is related to the NPA, as well as the restructured book, as well as recoveries, slippages, everything is on a positive note as far as the bank is concerned.
But while we understand that there was an impact of penal interest charge in your NIMs this particular quarter, and the pressure on the cost of the fund is across the industry, your yield on advances declined sharply, which impacted your NIMs. Can you explain why is the yield falling and what's the way forward?
It's a regulatory measure that has been taken, and it has been implemented from the quarter, which is the Q3 onwards. So September and October onwards, all the banks have been given instructions by the Reserve Bank of India not to charge penal interest, but this will be consumed as penal charges. So this change has happened across the industry. As a result, this particular block has been taken away from the interest income element. So as a result of that, anything that we compare, we need to box in this effect also. So if you take this into account, the NIM for us for the 9-month period stands at 3.32%, which is actually quite within our guideline. Maybe in the next about 2 quarters, what we will be doing is a conscious strategy, which has been stated in the last year itself, which is a churn. One is that we are growing the retail advances. The second is that we are moving away from the low yield advances for larger PSU, which was opportunistic. And third is that we are putting up direct to corporate advances, which has been reflected in the growth as far as the advances book is concerned and the yield is concerned. The real pressure on NIM is as a result of the cost of deposits and cost of funds. So this has been on the high, and this is true across the industry. We believe that this will taper down as we move forward. Because there is a very wide kind of anticipation related to the interest rate cut and thereof. So as a result, the repricing of deposits and the deposit rates, which are currently on a very high, is something that would moderate. Last but not the least, we as a bank had taken a very conscious strategy in the last 2 quarters not to chase high cost bulk deposits. Now that is also something that the bank resisted from doing, and that is also a result where while we did not grow on the deposit, the churn, which is the retail engine, has kicked off. The retail engine for the bank, both in the asset and the liability side, has kicked off because of the structure that we have put in place. So we are in the middle of a transformative journey, and I think we've reached that point of inflection where we believe that we are well placed to kind of grow from where we are.
But also your deposit growth has also faced some challenges this particular quarter, and sequentially the growth is stagnant. But what is the conscious call to slow down the growth in order to avoid the bulk deposits, and what's the way forward?
So this is what I said earlier, that our bulk deposit used to be almost like 8% of our overall deposits, and that has come down to less than 6% in this quarter, and it will move down. So we are moving away from this high cost bulk deposit, which are for shorter tenors, which is not very lucrative from a banking perspective, and it is not long term because we are looking for granular deposits. So the same thing has been replaced by the retail granular deposit, which is why while we have grown on the retail, while we gave away and we did not really go for the high cost bulk deposit, it was relatively flat, the overall aggregate deposit numbers. But then over a period of time, what will happen is that in the next couple of quarters, we will see that the deposit numbers will grow up because of the retail accretion, which the whole bank is really monitoring on a day-to-day basis. And I think there is definitely the branch franchise which is kicking in over 930 odd branches, plus the digital and also a lot of government business. All of those, including the CASA buildup, is something that the bank is focusing on.
Really appreciate your time. Thank you very much for joining us. And